Will Disney beating expectations on both the top and bottom line? Revenues coming in at $5.3 billion versus analyst estimates of $5.14 billion. Adjusted earnings also beating estimates, coming in at $1.84 per share. Analysts had been expecting just $1.55 per share. You see Disney now trading up 1.3% on that news. Now, digging into the different divisions here, there's always a lot of interest in the Media Networks division. Worth noting that Media Networks revenues and operating income both increased by 7%. If you look at what's driving that upside surprise, particularly in the earnings, Disney's earnings, it really is outperformance versus expectations in every single one of these divisions. Now, Media Networks, because of ESPN, always in focus here. It looks like there's outperformance in terms of operating income, both in broadcasting as well as in the cable division. So cable division operating income of $743 million versus Wall Street expectations of $688 million. Broadcasting revenue $408 million versus $277 expected. They attribute this to affiliate revenue growth, increased ad revenue, as well as higher program sales, partially offset by higher programming costs. ESPN did see a decrease as expected due to higher programming costs, partially offset by affiliate revenue growth and an increase in ad revenue. Now, this is the first quarter that Disney is releasing its earnings with a direct-to-consumer and international division broken out. So they had announced this, and analysts had been given some numbers about what to expect in terms of how this would have impacted past earnings. So this is the first quarter we're getting this new division, and this is, of course, impacted by Disney Plus as well as ESPN Plus, which launched last year. International, direct-to-consumer and international had an operating loss of $136 million in the quarter. Guys, back over to you.
Looks like that one was affected by a big foreign exchange hit on international. Julia, thank you. Digesting some of those Disney numbers, Mike, which look pretty strong across the board.
They are pretty strong, yeah. I mean, I think parks in particular was an upside surprise as well. 10% year-over-year growth in operating income for the parks division. So that was one that Julia did mention. But yeah, I do think it's basically a good quarter. I don't think there's a ton of surprises in here. I think that the focus is going to be on, okay, now we know the baseline for the sort of starting point net loss for direct-to-consumer and all the rest of it. And I think the big story is going to be how the company characterizes that rollout, what's going to be included, pricing expectations for uptake and things like that.
And as you say, Mike, the parks and resorts, 6.8 billion revenue. The expectation was 5.5. So throughout, that's probably most of the revenue beat. Nonetheless, decent numbers throughout. How impressive is it that they've changed the narrative here? And we're no longer talking about cord cutting and how that's affecting ESPN. It's all of the other opportunities that they're seemingly delivering on.
Absolutely. And if you look at it, and this is a stock we've been adding to, it's trading at 15 times earnings, which is very reasonable for a company like Disney. And what they have is its multifaceted approach. You've got the hard assets like the theme parks, but the content is really what's going to drive this company now. And I think when you've got a baseline where ESPN is actually not hurting, and you've got streaming coming on, and you've got what I think what we're going to be focused on is what is the growth rate going to be of the streaming and how that's going to fall into the bottom line, along with the Hulu investment they have. Those are going to be the catalysts for this stock for over the next couple of years.
I mean, he says it right in the first quote, Bob Iger, you can always tell in the top of the release, building a robust direct-to-consumer business is our top priority, and we continue to invest in exceptional content and innovative technology. They have changed the story here.
Oh, without a doubt. I mean, between the purchase of the Fox assets and this rollout, it's really all about exactly how quickly the Disney branded direct-to-consumer can become right up there at the top of the menu with Netflix and Amazon Prime in terms of the default choices for entertainment.
And Surat, can they make that immediately profitable in a way that Netflix and Amazon Prime might not be because of the long build time for their library?
So they have a couple of levers to pull. What's interesting is because some of the content's already homegrown, so they don't have to spend on Marvel and Star Wars and a whole bunch of other things that they already own, where the levers that they can control costs are live entertainment. And that's kind of where you're competing with the others. But the combination of those two is a pretty powerful tool to have in your arsenal, and I think that can drive earnings going forward.